Hi, I'm Kelly Stain. Welcome to my expert series where I bring you trusted insight from local experts to help you plan well, live smart, and age with confidence. So today I'm with Doug Silverman. He's with Edge Home Finance. Doug and I have known each other for many, many years. He is one of my trusted mortgage experts, and I'm so thankful you're here with me today.
Thank you very much. Yeah, it's awesome. Thank you.
So tell me, let's get into it. So you're with Edge Home.
Right.
That's a broker, a mortgage broker.
Correct. Yeah.
Can you tell me the difference between a mortgage broker and a banker?
Yeah, absolutely. So the major difference is a banker only has one institution that they can get financing from for their clients, where I have about 100 to 150 different lending resources across the country to provide different options for my clients.
Oh, wow.
Yeah.
Okay.
Yeah. So it lends itself to a lot of flexibility. Like if one of my lenders is slow for whatever reason, their turn times are a little sluggish and I need to close in 3 weeks, I can pivot to another lender. Or if rates go down during the process and I have a buyer that's already locked in, I can pivot to another lender with a lower interest rate, assuming there's enough time to close. If there's programs that might be priced better at other banks versus another bank, I can pivot to that bank as well. So it gives me a lot more options when it comes to pricing, programs, and just flexibility, overall flexibility to help my clients win in the market.
So it sounds like it also gives you a lot more creativity and flexibility.
Yeah, absolutely.
Can you give any examples of creative things you've done over the years?
Yeah.
You can get deals done.
Yeah, absolutely. So I have a client recently who got pre-approved by another lender. They use their tax returns, which is standard for a conventional mortgage, to qualify, but they only could qualify for up to about $1 million, which in their market wasn't really helpful. They were self-employed, so I could leverage their business bank statements and use their deposits in those bank statements as income. So now they're pre-approved for up to about $1.5 million, making them much more competitive and allowing them to get the house that they really want for their family. So that's an example there. Also on the investor side, I can get super flexible. Like I just helped a client get financing. She had a 538 credit score.
Thanks.
Yeah, which in the normal world really wouldn't be possible, but because of the flexibility that I have and the creativity that I can offer, I was able to get her cash to help her pay off other debt, hopefully improve her credit score, and then help her get into another home. That was her goal overall. But I was able to get her some cash out of her current property and help her accomplish goals that way.
Okay, so speaking on the credit, everyone's curious when they get approved. They're looking at their Credit Karma or their free credit reports once in a while. What is a good credit score? How does credit affect your financing, interest rates, all of that?
Yeah, absolutely. So A+ credit in the mortgage world is anything over 740. When you get down below 620, it gets a little wonky. I mean, I can do loans down to 500, but it gets a little wonky once you get below 620. So
620, okay.
Yeah. So 740 and over is A+
in
the mortgage world. Now, if you have 800, there is some nuance there as far as pricing, but you want to be 740 and over in the mortgage world to maximize your capabilities as far as lower interest rates. Obviously, there's different ways to maintain that. And where my clients have been getting screwed a little bit is with the student loan thing. Some of them had deferred payments for many years, and then all of a sudden they have payments due. So you got to be careful of that. And as far as maintaining great credit, obviously you want to have low utilization rates of your current credit cards. If you use them, try to pay them off. Obviously, you don't want any 30-day lates on your credit. If you're going to be late, make your payment within the 30-day window of your due date, and just stay on top of your bills. I mean, I had a client that had a small collection out of nowhere. He didn't even know, and his credit score, instead of the 750 he anticipated, was actually closer to 650.
Oh wow! So that affected it a lot.
Definitely, that affected his ability to get approved for where he wanted to be, and impacted his pricing.
Well, one of the things I come across with first-time buyers or people that aren't first-time buyers, they just haven't maybe bought a house in 20 years. I always recommend, and part of why I do this as expert series, is to plan. So getting pre-approved and running those credit reports sooner than later, because those things might come up, right? That they didn't even know they had a collection or their credit was lower than they thought.
1000%. Yeah, if you want to get into the market in the next 6 months, I would say get pre-approved and kind of get a bird's eye view of where you are. Right. I can do it with doing a soft credit check, so it doesn't impact anything there. So it's very low risk, high reward to kind of figure out where you stand, and so you can set your goals accordingly.
What are the other thresholds? There's like 680 and above, like get you a good rate. Like where are you with interest rates?
So every 20 points impacts your pricing. So 720, 740, 700 to 720, 680 to 700, etc.
All right, that's
so on
good
and so
to know.
forth. Yeah, yeah.
So tell me, you said credit score and it impacts your interest rate.
Right.
Interest rates obviously affect your mortgage amount and how much you pay per month, right?
Yes.
So with interest rates, you know, they've gone up the last few years. They're now kind of steady in the sixes. Compare what's an interest rate at 6.5 and 7, or, you know, what's the difference? How does that impact your monthly payment?
Yeah, so good question. I mean, the difference between like 6.5 and 6 3/8 on a $400,000 loan is like $30 a month.
Okay.
Where you see more of a difference if it's like a half a point lower, then you're in like the three figures, like 100 to 150 bucks a month. But what most home buyers don't realize, and you probably see this on your end too, is that the taxes and insurance impact on the payment. And I'll get some sticker shock there. And it's mostly because they're looking in maybe a higher tax area. Like for example, like an $8,000 annual tax on a property versus a $6,000 tax on a property is like $150 a month difference in payment.
Right. And then add on interest rates have increased. So that's, you know, could be $300 potentially monthly.
Right. And then you have insurance, which has gone up, which is also
gone up.
Yes, it's fantastic. So
Trifecta.
Yeah, it's unbelievable. So my point is that interest rate is important. I get it, but there's other drivers of the payment, and you have to be conscious of that as a home buyer, where you're searching low tax area versus high tax area. What are you getting for those taxes too is important. Like some people don't mind paying the higher taxes. You've got great schools, right? So people don't realize that. So interest rates do have an impact, but I believe, and I tell this to my clients, like you got to be careful of taxes too, because that is part of your payment in most cases.
So if rates are 6.5 right? I don't know what they are. What are
they're
those?
a little lower than that.
Like a little
like 6
under
1/4,
6,
give or take.
And they went to 5.5. Your monthly payment would change by what, like 150?
Give or take on a $400,000 mortgage. The higher the mortgage, the more impact it'll have.
Right. So that's not crazy.
It's not crazy. That's why you shouldn't be sitting on the sidelines.
Get rid of that
Waiting for
cable
rates
bill. That's a lot. I get it, especially for first-time buyers. They're the ones that are struggling. I get it.
Yeah, it's like actually less than that, but yeah.
Not major. What other common myths to come across in your world that, like you said, like the interest rate difference, like people think that's huge, but it might not be as huge as you might think. What other myths are you coming?
A huge myth is the impact of less than 20% down. People think mortgage insurance is like the devil, but mortgage insurance in most cases is obviously FHA. It's the Federal Housing Administration program, right? It's a little bit higher than a normal conventional your mortgage insurance, so I kind of get it there. But if you qualify for a conventional mortgage and 5% down, usually the mortgage insurance might be like $100 a month or something like that.
It's not
versus putting down another 50 grand. If you do the math, it makes a lot more sense to just leverage that mortgage insurance to put less money down, put your cash in your bank, let it work for you in other ways, versus getting to that 20% down marker.
That makes sense. Yeah. What about, do you see a lot of 30-year or 15-year options, or people shopping 15-year? What's the benefit
Especially
there?
on the refis. I have a client now going from, this is actually crazy. You wouldn't think it'd be that different. She's going from a 20-year to a 15. But her interest rate was like over 8%.
At the 20-year?
At the 20.
Wow.
Yeah, she had some issues. Credit issues.
Yeah.
Which caused that. Back to the credit conversation. But I'm putting her in at 15 at 5 3/8.
Wow.
And it's saving her, it's a big loan, it's like $800,000 loan. So it's saving her like almost $400,000 in interest over the life loan just by cutting it 5 years.
Wow.
So I'm seeing a lot of that in the refi world, going from 30s to 20s, 30s to 15s.
Yeah.
The 15-year interest rates are very enticing right now versus where we've been over the last few years. So it makes a lot of sense. It does obviously increase the payment, but if you're comfortable with that, and like with this specific client, she's looking at the long view, like her kids will be out of college in 15 years. It's like perfect timing. You know what I mean? Like she'll be like free and clear of the mortgage in time for her kids actually to be in college. She'll still pay the college is my point. But so I am seeing more of that.
That's good actually, because people that have been in their house a while, that have equity or plan to be in their house a while, it might make sense for them to refi out of their 7% that they might have gotten 2 years ago.
1,000%. Yeah. I mean, obviously I have clients that go from a 30-year and stay in it because they like in a 30, you can still have the flexibility to pay it down if that's your goal. Or you can just enjoy the more cash flow and accomplish other goals that way, like pay off debt or put more money in savings, whatever it might be.
Yeah.
So
what are you seeing in the market? Like Are you seeing a lot of like first time buyers still, or more people that are buying their second house or downsizing?
Yeah, I'm seeing my mix of what I'm seeing personally right now is first time buyers and investors.
Investors, okay.
The move up buyers, it's a little bit of a challenge because of the sales contingency, which we can help eliminate. I use equity lines of credit for that, and we also do bridge financing.
Which I did actually want to touch on, yes.
Yeah, which can help. So yeah, but it's still a challenge for a lot of folks to eliminate that contingency, which may be preventing them from moving up. Plus the interest rate lock-in effect, right? They're at 3% interest rate. They don't want to lock in a 6% interest rate, have that impact on their monthly payment. It would have to make a ton of sense. So in a lot of those cases, it's a growing family, or they're in a small space and they absolutely have to move. I'm seeing a lot of that, but that lock-in effect is definitely having an impact on folks moving up to different houses as well.
Yeah, and I'm also seeing on the other side, like downsizing clients, people that are planning to move to their next home, all of their equities in their house already. Maybe they don't even have a mortgage, or that's where their money is in their house.
Right.
So getting the bridge loan or the home equity could make sense for them, right, to get into their next place.
Correct. Yeah, absolutely. Yeah, so we can do an equity line of credit, close in like 2-3 weeks, and then they'll have that cash available to them to make either an all cash offer on their next house or help them with the down payment.
With the down payment too.
Yeah.
Because sometimes they're still getting small loans.
Yeah, and I do have programs where we can eliminate the debt to income ratio on their previous home as well.
Wow.
So that is an option. So there is some creative ideas we can get into. But still, it's a challenge because of that kind of lock-in effect, and unless you have to move, it just makes it tough for folks.
But it's good to know options and plan and have those plans in place.
Yeah, absolutely. Love to consult with those people and go over those ideas and see if it makes sense. For sure.
Anything else you want to share? Any tips?
No, I just think in general, if you and I posted this today actually on Facebook, if you're comfortable with the payment on your pre-approval, give or take, and you have money to put down and you don't own a home yet, you should absolutely look to buy a house.
I did see what you posted today. It was a chart of all of the equity or
over the last I think 70 years, give or take. It was 60 years or so.
It was
1940.
It was what?
80 years.
The chart of what was it showing every year that prices went up or down or values?
Yeah. So over the history since I think it's from 1940, the price of real estate in America has gone up year over year, with the exception of maybe a handful of years, including 08, the collapse of 08. And
08 was the highest, went down.
Yeah, and I think there was one other year from 1940 to 2000.
Yeah.
I forget what year it was.
I think it was in like the
But the odds are in your favor. If you can get in the market and get in a house, look, I know it's tough and I get it, although it's starting to loosen up a little bit. You could probably speak on that. But you should absolutely get a house, especially if you plan on living in it for more than five years. It's a great investment. You build equity. You don't have to worry about a landlord, obviously, being a nag, and you can decorate the house how you want and all that good stuff too. But it makes a lot of sense fiscally, and I know there's a lot of fear out there, but if you could swing it and you qualify, you should absolutely get in the market. Make it work.
There you go.
Yeah.
This is really helpful.
Thanks, Kelly.
I think
it's
you
great.
provided really good
Thanks.
tips for people to get started. Again, planning is really important. Never too soon to plan and connect with a mortgage professional. I'm sure you work with a lot of financial advisors as well to help the whole package for
Absolutely.
people.
Yep.
So yeah, thanks for being here.
Thank you so much. It's great.